All right, everybody. Thanks for sticking with us through the second part of this video series. If you did not listen to the first one, please go back and view that. Again, for more information on the infinite banking concept, how you can learn more, our blog, our radio show and podcast, our article database. We have some other articles that talk about the infinite banking concept for business owners, for doctors and dentists, for real estate investors, for farmers, and I definitely think you will get some value out of that. So definitely check our website out at www.paradigmlife.net. Okay, so let's go through to the second part of this video, which talks how to implement the banking system into your own personal finances. Now, you have to remember that a system is something that we follow on a daily basis. For instance, try to wake up tomorrow morning and brush your teeth with your left hand, okay? Or try to suddenly, wash your body in the opposite way, or get dressed putting a different leg in your pants before the one that you usually put in first. Okay, we're all used to systems. We're creatures of habit as human beings, and systems, we would die without systems. Our society is based on systems. Okay, so the infinite banking concept is a series of laws that you impose, or rules that you impose on yourself, and it becomes a system on how you use and manage your money. Okay, now hopefully I've been able to prove that banking is very lucrative. Now, what is the hiccup that made the banking industry collapse in the last couple of years? It's the inability of borrowers to repay their loans. Maybe not inability, but they're just basically they're ceasing of paying back bank loans, whether they were credit cards, automobile loans, business loans, or mortgages. Okay, so let's continue. How do you implement this in your own personal life? The banking model, you basically take the four roles of the banking concept. You are the banking concept's depositor. So let me get some black colors here. You are the depositor, role 1. You are the bank, role 2. You are the borrower, role 3. And then you ultimately profit from the system. Okay, so let's use some examples. Now, where would you get money to deposit into your banking system? A system sometimes takes a while to get adapted to. For now, you might be able to take your long-term savings. Now, long-term savings is money that is going into 401ks or IRAs or Roth IRAs. For information on why those might not be the most prudent investments that are out there, please visit our blog and please visit our website and listen to our podcasts. There's lots of evidence out there that show that taxes are going to be higher in the future, so the money that you're not having to pay taxes on right now, you're ultimately going to have to pay more. The lack of liquidity inside of these plans leads individuals to need credit in order to purchase things, which ultimately increase the overall purchase price because of the interest that you have to pay back to the creditor. Okay, so removing your long-term savings plans, such as money going into a 401k or IRA or Roth IRA, now starts to come into your banking system. Now, this banking system is a interest-bearing plan. We will have another video that will talk about the actual financial vehicle that we use for this model. It's an interest-bearing vehicle. The interest has a lot of tax favorability. Okay. Basically, it has tax-free growth and potentially tax-free withdrawal. Okay, so growth and withdrawal. It is 100% liquid. You can use it at any time for any reason. Now, when you do use it, you are going to impose these regulations or rules that I've just talked about. When money comes out of your banking system, it comes out in the form of a loan. Okay? Now, when you purchase a car, when you go on vacation, when you put a down payment on real estate, when you put on braces for your child, when you repair your car, when you put a home remodel or addition on your house, you finish the basement, you remodel the kitchen or the bathroom, okay, money comes out in the form of a loan. Now, the product that we use is remarkable because all of the money that you have inside of this system continues to grow as if you never withdrew it. So let's assume that you have $100,000 inside of your banking system, and you took out $25,000 to buy a car, $5,000 for vacation, $2,500 for braces, and $10,000 for different repairs around the house. If this was a savings account, your balance in the savings account would be reduced by the 25, the 10, the 25, and the 5. But even though you've taken out money for all these different things, your money continues to grow with tax favorable interest inside of your banking system at the entire principal balance of your banking system. Okay? Now, the rule that you impose on yourself is you treat these purchases as loans, because they actually are loans, and you pay yourself back at a given interest rate. Okay? Now, that interest rate can range whether it's the market interest rates for the particular purchase or it's an interest rate that you choose and feel comfortable with. We typically recommend a 10% interest rate. So why so high, you may ask? Great question. That was rhetorical, huh? Go and look at Coca-Cola. In 1993, Coca-Cola implemented something that boosted their stock more so than any other time in history based on a financial and business decision. And it was the concept of economic value added. Now, economic value added works like this. Coca-Cola previously would finance their bottling companies and distribution centers with cash. They needed to open up a new distribution center. Here's $10 million. Open it up, Mr. Project Manager. Okay. In 1993, they actually started to lend money for these types of improvements or increase in business. Okay, so instead of saying, here, bottling company, take $10 million and make the bottling plant, they would lend the money and have these project managers subsequently pay back interest. So as you can imagine, these project managers started to use the money much differently, which ultimately allowed the plant to be built more efficiently. Okay, and ultimately Coca-Cola made more money, and their stock subsequently increased more so than any other time in history based on one specific financial decision or business decision. That is what we recommend you to do. Now, if you were to walk into a Wells Fargo or a Chase or a Bank of America and ask for a $25,000 loan with the car, they would pull your credit. They'd make you provide tax returns or pay stubs, etc., to make sure that you have the ability to repay. When you take out money from your banking system, you have to do no such thing. Now, because of that lack of paperwork and lack of hassle in getting a loan, okay, we consider some value into that equation, and that value is 10%. Okay, so you pay yourself back with 10%. So not only at the end of the day will you have paid back the entire $25,000 car, you would have also increased the amount of money that goes back into your banking system by the interest that you pay yourself. Now translate this into everything that you're going to buy in the future. Hundreds of thousands of dollars of money will be spent on college education, cars, remodels, vacations. If you can use this system, not only does your principal balance continue to grow with compound interest, okay, growing bigger and bigger and bigger every single year, you're also able to pay for this and now actually increase the principal balance of your bank with the interest that you pay yourself. Okay? Hopefully this has explained the conceptual side of how banking works. On the next video, we will talk about the product that we use and why we use the specific product of high cash value permanent life insurance. Now that might make your stomach turn a little bit and maybe the hair on the back of your neck stand up, but this product has been around for eons. It's never failed. The companies that actually offer these products have been around for hundreds of years. These days, mortality costs have changed. Insurance companies have made it possible to have more cash value than ever before. And once you learn how to use these vehicles, your financial lives will transform. So stick with us to the next video. Thanks.